In this video, we're going to talk about capital budgeting techniques. It's actually a pretty simple process in Excel since we have formulas that cover just about every technique you can think of. So let's start with our data. Under the cash flows, we need to identify what are the cash flows that are expected to be received from doing this particular project. So in this case, we have a 5-year project, and here are listed the cash flows. Now, times 0 reflects the investment, the cost of the project. And of course, you notice here it says negative. It needs to be entered as a negative number. We also need to identify discount rates. The most simple version of this is just the weighted average cost of capital, or the cost of financing for the corporation. For this company, we say it's 10%. And then there are other more advanced techniques that we'll talk about in maybe some other videos that require maybe a reinvestment rate, right? What do you do with the cash flows when you receive them? So in this case, we're saying it's 12%. And of course, here the formulas are actually fairly simple. The net present value formula. Now, one thing you need to recognize is that in Excel, they have a formula called NPV. But NPV in Excel is not the technique. So if you notice here, we have net present value is the present value of the cash flows from 1 to whatever. But then we have to add the investment, right? So it's the present value of all the cash flows. That's what Excel calls NPV. And we also have to then subtract, or in this case, because of the formula, we need to add the negative cash flow of the investment. Internal rate of return is a pretty simple formula, equals IRR. You just highlight all of the cash flows that you have, and then you enter a guess. In this case, I guessed 15%. MIRR is the same thing. Again, it's another technique, modified internal rate of return. Enter the cash flows, highlight them. Now, in this case, you enter the discount rate and the reinvestment rate. And the profitability index is the net present value minus the investment, right? So it's the net present value of the project. And then you divide that by negative investment so that it stays positive. So in this case, the profitability index is 0.94. And we have formulas for that. It makes that fairly simple to do. Now, the other two techniques we have here, the payback period and the discounted payback period, require us to do a little bit of analysis, right? We have to understand how the process works. So this is the way it works over here on the right. We have an investment of a negative $100,000, and the first year, we receive $35,000 in cash flow, which means we have $65,000 more to recover. Second year, 25, means there's 40,000 to recover. Next year's 25 means there's 15,000 to recover. But the next year we have $20,000 in cash flow. So somewhere in this year, year 3 plus, between year 3 and 4, we're going to get all of our money back. So the technique just says, look, when this thing turns negative, you take the year before, 3 years, and we need to know the portion. So the proportion you take is 15,000. How much do we still need to recover, divided by the amount that we're going to receive in this last year of the payback period. So 15,000 divided by 20,000 is 0.75. So the payback period, once we calculate here, is 3.75 years. Now for this project, we also calculate the present value of the cash flows. so that we can do the discounted payback period. Now, when you go down the list, again, we have the same process, except what you'll notice is it never goes negative. So what that means from the discounted payback period, using present value cash flows, we're never going to receive all of our money back. So it's a strange situation. Doesn't happen in every project, but in this particular project, we can't calculate anything because it never goes negative. But if it would go negative, all we would have to do is the same process as over here. So again, hopefully that helps you understand how to calculate the techniques. Remembering what? That net present value is the technique that always gives us the correct answer. In this case, net present value was a negative $5,700. So this is not a good project. We would reject this project. In this project, we have a cost of financing of 10%. The project is only going to earn 7.39%. It's not a good project. The returns are less than the costs. Modified internal return is 10%. That's less than the reinvestment rate. Again, in general, this project is a bad project. Profitability index is less than 1, right? It has to be greater than 1 for it to be an acceptable project. So again, understanding the techniques, the calculation is easy. It's the understanding of what the techniques tell us and how we can use that information that's the most important. Look forward to seeing you soon. Bye-bye.